Today, I want to share a conversation with you. This is a conversation you will never read in any book, and you will never learn in any course. This was a private dialogue with a top trader, a man with over 25 years of real-world experience at a multi-billion-dollar futures firm on the very last day of his career. On that day, he held nothing back. There were no corporate politics to worry about, no career moves to consider. He laid everything on the table, everything he had earned through countless blown accounts, endless sweat, and sleepless nights. He told me he felt a profound responsibility to ensure that all his hard-won knowledge didn't just disappear with him. What follows will be long, but I urge you to listen to every word, because this might be the most valuable thing I could ever share with you. I will not summarize or distill it. I am going to retell, word for word, the wisdom of a master. He broke it down into 6 parts. The first part he called the foundational secrets, are the core truths that most of us get completely wrong from the very beginning. The first secret, he told me, is this: you are not in the business of predicting the future. You are in the business of managing probabilities. He said that conventional wisdom always implies that successful traders have a crystal ball. But the reality is, nobody knows where the market is going next. The real winners aren't right more often. They've just built a system where the cost of being wrong is tiny, and the reward for being right is enormous. He gave me an example he never forgot. The collapse of Long-Term Capital Management (LTCM) in 1998. That firm had 2 Nobel Prize winners on board, literally the smartest guys in the room. Their models were flawless 99.9% of the time. But they were completely annihilated by the 0.1% black swan event. He was young then, and he said, from that day on, I stopped caring how accurate my model was. I only cared about one thing: when this model fails, how much money do I have left? So, he stressed, stop searching for the perfect indicator. Spend 90% of your energy on risk management. Your first job is not to make money. It's to ensure you're still at the table tomorrow. The second foundational secret: the market is not your enemy, you are. He said we love to imagine there's a whale or a smart money entity fighting against us. The truth is, the market doesn't even know you exist. The thing that causes you to lose money is your own emotion, your greed that makes you chase the top, your fear that makes you sell at the bottom, and your hope that makes you cling to a losing position. He told me about his single worst loss. In 2008, crude oil was collapsing from its $147 peak. He was convinced it was just a correction. He bought at $120, added more at $110, and by $100, he had nearly his entire book on the line. He said, I wasn't analyzing anymore. I was hoping for a rebound. The result? Oil crashed below $40. He told me, the market didn't beat me. I beat myself. So, every morning, your true opponent is the person in the mirror. The third foundational secret: the depth of your information matters far more than the speed. He said traders today are obsessed with the fastest news feeds, the most expensive terminals. But by the time you read the news, the price has already moved. You will never be faster than the high-frequency trading algorithms. Your edge is in deep thinking. He told me a story about his mentor. In the early 2000s, when everyone was obsessed with China's GDP data, his mentor, a legendary grain trader, was studying China's freshwater resources and port capacity. His mentor said, everyone is looking at demand, but the real bottleneck is in supply and logistics. By studying this boring, second-level data, he called the mega bull markets in soybeans and iron ore years in advance. He wasn't the fastest, he was the deepest. The master's final word on this was, stop chasing headlines. Ask yourself, what is the market pricing in right now? And what is the market completely ignoring? After laying that foundation, he moved to part 2, tactical intelligence. The specific, operational secrets that separate the top 1% from everyone else. He said there's a daily habit with an incredible compounding effect, a post-market review. Not to check P&L, but to answer 3 questions. 1. Did I follow my plan with discipline today? 2. Did my emotions influence any of my trades? 3. Did the market do anything today that surprised me? In critical conversations, he said he only ever asks 2 questions. What is the most consensus, crowded trade in the market right now? And what is the pain trade? What move would cause the most people the most pain? He said the biggest moves often happen in the direction of the pain trade. On timing strategy, he said most people get it wrong. It's not about when to get in, it's about when to get out. He has an ironclad rule: never let a winning trade turn into a loser. Once a trade shows a decent profit, he immediately moves his stop loss to his entry price. Your psychology completely changes because now you're playing with the house's money. On resource allocation, he argued your most precious resource isn't your capital, it's your mental energy. He only trades 3 to 4 markets he understands deeply. Most days, he does nothing, he waits. He waits for the plus setup, where fundamentals, technicals, and sentiment all align. He said, it's better to miss an opportunity than to make a mistake. Most people lose money because they trade too often. On networking, he said real relationships aren't built at cocktail parties, they're built on an exchange of value. Find the top people in your niche and figure out how to provide value to them. Maybe it's your unique take on market sentiment, or a piece of data they missed. When you can provide value to top players, their networks will open to you. Finally, he shared his decision-making framework, a simple traffic light system. Green, all conditions are met, go in with size. Yellow, some, but not all, conditions are met. Take a small pilot position or just wait. Red, any idea that doesn't fit the core strategy, no matter how tempting, is absolutely forbidden. Next was part 3, strategic wisdom. The big picture view of how the industry really works. He told me there are only 2 real forces that drive futures markets: the credit cycle, interest rates, and supply and demand imbalances. When central banks are printing money, everything goes up. When an industry has been underinvested for years and demand suddenly explodes, you get a supercycle. Your job is to know which major cycle we're in. He also said that every 5 to 10 years, the market goes through a regime change. Sometimes trend following works, other times, mean reversion is king. Most people go broke using one strategy for all market conditions. He told me to watch volatility, the VIX. The rules of the game are completely different in high volume and low volume environments. He stressed the importance of the weekly commitment of traders caught report. There are 3 players: commercials, large speculators, and small speculators. He said when the commercials who have the best fundamental information are positioned in the same direction as the large speculators, and opposite the small speculators, it's an incredibly powerful signal. He also talked about technological shifts. The biggest change in 20 years is the rise of algorithmic trading. This means short-term price action is filled with noise. For a human trader, this means you have to lengthen your time horizon. Focus on the weekly and monthly charts. Stop trying to beat the machines on a 1-minute chart. Finally, he said the people who always win are either the rule makers or the best rule adapters. The people who always struggle are the ones who are always chasing last year's winner. Part 4 was about relationship and political intelligence, the human factor. He said you have to learn to identify the real decision makers. They aren't the analysts on TV, they're the portfolio managers who control billions. How do you reach them? He said, you must become a signal, not noise. Consistently produce insightful research. When your insights help them make money, they will find you. He described the successful personality type, a little boring in their personal life. Extremely disciplined, emotionally stable, almost robotic. Their communication style is concise and data-driven. He said, in this business, the flashier someone is, the faster they burn out. He warned me of political landmines: never, ever talk about your P&L publicly. It will only breed jealousy or contempt. Also, never trust an inside tip. 99% of them are garbage, and the other 1% will land you in jail. He explained in written hierarchy, in this industry, survival commands more respect than short-term profits. Someone who has lasted 20 years is far more respected than a hotshot who made 10x last year but might be gone tomorrow. And finally, on navigating conflict, when you disagree with the market is always right. Admit you're wrong immediately. When you disagree with a person, use data and probabilities to make your case, not I feel or I think. Part 5 was perhaps the most painful, but also the most valuable: failure patterns and warning signs. He shared the early warning signs that things are about to go wrong: when you start making excuses for a losing trade, when you start checking your account constantly, when you break your own stop-loss rule. He said these are signals that your emotions have taken over, and you must force yourself to get out and take a break. He pointed out common blind spots: survivorship bias, you only see the winners, not the thousands who failed; and the anchoring effect, you feel a price should return to your cost basis, but the market has no memory of it. He warned me that the four most expensive words in financial history are, "This time it's different." He also mentioned that a market condition that signals trouble is extremely low volatility. When everyone is complacent and leveraged up to earn tiny returns, that's often the calm before the storm. And if you do suffer a major setback, how to recover? He said the people who come back all do three things. 1. Stop trading completely for at least a month. 2. Conduct a brutally honest post-mortem of every mistake. 3. Start again with laughably small size. The goal isn't to make money back, it's to rebuild discipline and confidence. And finally, Part 6, Future Intelligence. What he sees coming, based on his decades of pattern recognition. He said that in the next 5 to 10 years, AI and big data will completely transform fundamental analysis. At the same time, geopolitics will become more important than ever. The skills that will become more valuable, therefore, are coding and data science, but the most valuable skill will be cross-disciplinary synthesis, the ability to combine quantitative models, geopolitics, and market psychology. He saw emerging opportunities in markets not yet saturated by Wall Street, like carbon credits or water futures. He also pointed out underrated threats: sudden regulatory changes, and algorithmic herding, where too many similar quant strategies can cause a flash crash under stress. Finally, he gave a piece of positioning advice for newcomers like us. 10 years ago, you could be a pure technical or fundamental analyst. Today, you have to be a hybrid. A strategist who understands tech and data. Spend 80% of your time learning the timeless things: economic history, psychology, risk management, and 20% on learning the latest tools. That was his final testament. And now, I've passed it on to you. I hope it saves you years of struggle. Or maybe, just maybe, it helps you survive this incredibly difficult game.